Thank you very much, and thank you for having me here today. I think I'm invited here to give a practitioner's view of some of the challenges that are facing us. And we heard from the previous panel that lots of good initiatives going on in terms of creating standards and discussing a bit of data and so on. Reality as an investor is that the world is really, really complex. Despite fantastic ratings or despite fantastic standards in terms of green bonds, whatever it may be, the reality of an investor is very, very complex because we have the fiduciary duty to actually invest according to investment mandates, and we have to do it in a way that is responsible, but also according to our investors or end clients' needs. Now, I have 15 minutes to cover sustainability and technology. It's a bit of a challenge. I will focus on the net zero transition and the data and analytics that we see and what we need to develop in order to get there. So let's start on the why this matters. And I think many of us in this room agree that this is a very, very important journey for societies, for the world. But there are actually other reasons for that, even if you don't believe that, if you're more short-sighted. You can definitely observe that we have a lot of regulatory action going on that will affect investment and portfolios. And you also see that there are definitely new technologies coming. We have companies disrupting old companies. So that is also something that is affecting, investment decisions going forward. So my point here is that even though you are not a believer, so to speak, and you're not driven by ethics, this is something that you have to relate to. The journey has started. It is very complex. It is not a smooth transition. We have bumps on the road, and there is just a lot of risk to relate to, but also a lot of opportunities. A good example is, of course, what has happened here in the start of the year with the war in Ukraine, the energy supply disruptions. That is definitely suddenly affecting the net zero transition and requiring societies, but also investors to adjust our plans, our portfolios in order to cope with that type of noise along the way to a net zero transition. So my point here is that no matter where you come from and where your starting point is, as an investor, you cannot ignore the transition. So you need to figure out what tools you need in order to construct portfolios that are aligned with the fiduciary duty that you have. So the why, I think, is pretty evident, but it is the how that is the big question here. And there are actually two hows. One how is how to do it, but it's also about how long time and how fast this will actually take. If we take a look at a simplified map here, you can look at different scenarios. You can look upon this as global emissions for the world. You can also look upon this as a portfolio or as sectors, or even at single companies, how they will transition over the coming many years. And again, going back to the need for tools for investors, if you run a portfolio, you need this map for each single security. You need to have a view on which securities will cope with this transition and which will not. So that is a pretty challenging assignment if you think of where we are right now with data, with standards, and so on. We are really at a very, very early starting point in order to have a clear view of this path. If we look at a few indicators here, though, it has started. If you look at first on the right-hand side, if we start with there, you can see this is the share of net zero pledges. We have a lot of countries have given out commitments to net zero. We also have a lot of financial companies, and we have a lot of company or corporates that have also done so. You can measure this in different shapes and forms. One thing is a commitment to net zero. Another thing is you have science-based targets, or how granular and detailed your commitment is, whether you have signed up for TCFD, and you can make many types of indicators here. But the direction is pretty clear. We have more and more signing up for this journey. And interestingly, also, if you look at weighted average cost of capital in the market, what you see on the left-hand side, that is a chart of Russell 1000, where we have basically grouped in two categories, either companies that we believe have started to position themselves for a low carbon transition environment and companies that have not. you see that the weighted average cost of capital has actually declined for the ones that have prepared. So the market is starting to price in the risks that we have in our portfolios and the risk a single company has in terms of adjusting to the environment. We've developed a framework, and this is what we use when we talk to our clients, to asset owners or to wealth managers that are managing money. And a way to look at this is to say, well, we have three categories. We call it navigate, drive, and invent. And the category we call navigate is basically for everyone, no matter your own purpose, no matter how fast you want to do this, you have to relate to the climate transition and to climate risk as an investment risk. That requires a toolbox. It requires a lot of data and analytics. And as said before, we are starting to get there. One example is that you can start when you do your strategic asset allocation and you have some capital market assumptions to guide you on your allocation, you can start to adjust those capital market assumptions with the climate transition. Some sectors may be doing better than others. Some regions, some countries may have an overweight or underweight of certain companies that will do better or worse. So you can start to take this into account. If you take the next one, drive, that is the one that is maybe the most, you can say, that where it gets a lot of attention at least. I think the navigate is a little bit underestimated in terms of how complex it actually is. But in the public sphere, there's a lot of discussion of how can we drive the transition. And we have a lot of companies, as I said before, that have pledged to a net zero. So they have to figure out what is the strategy to drive this and to actually take responsibility for companies and their portfolios to get aligned. And typically where the discussion starts is around exclusions on one hand or engagement. Do you save the world, so to speak, by excluding a lot of companies? Then you are without influence. Or do you have a better chance of influencing companies if you are actually a shareholder? So that is the first stand. The jury is out, I would say. There are both investors doing both one and the other. Interestingly enough, you also have some doing both in the sense that starting to exclude some, but realizing that they want to have influence on the laggards that they believe they are able to influence and to get on the journey. And I think that is very much the approach of the largest asset owners that believe that they have a voice. So I think that is a good example of investors really taking the responsibility and being an active owner. What you also see, not just about engagement, but also in terms of composing portfolios, we see investors that are starting to adjust the benchmarks to have benchmarks that are weighted according to positive impact. It can be to the SDGs, where we have investors that are kind of underweighting or overweighting companies according to the positive impact that these investments can generate. Again, it's hypothetical in a way, because how good is the modeling behind this? How good is the data behind this? But the methodology as such is one that I think will continue and develop going forward. And finally, we have the last category, invent. It is something that I think we should not underestimate, and it is something that can be a real strong driving force. Also, maybe in regions where there is not so much, you can say, purpose and ethical drive in terms of taking responsibility, and where maybe also regulation is a little bit less forward-looking than what we have in the EU. New invention of new technologies is definitely a way and an opportunity as an investor to invest in the right companies. And this is very much going into venture and growth capital to figure out what are the new technologies that we need to have in order to succeed. And what is important to realize here is that even though we talk about net zero for us all, so to speak, there will be companies that reach net zero, but there will definitely also be companies that are not, where it's not possible for them to get there. And that has to be offset by technologies where we have carbon capture and other types of technologies that will enable the global net zero, so to speak. Another issue to bring up here that I think is the need of governments to support investors. We cannot expect investors to actually pour money into new projects and take risk where we compromise on our fiduciary duties. We need governments to take first loss, to incentivize investments into new technologies, and especially also to incentivize investments into emerging markets. We talked a lot about emerging markets earlier, that they have to come on this journey as well. But of course, they have also other challenges, and it has a cost. That cost probably has to be shared. But again, activating private capital is not possible if the returns are not attractive. So there is a very, very important role to play here for governments in order to enable this transition also from a risk perspective. And then to the complexity of technology and the toolbox that we need for this. This is an attempt to illustrate what we are talking about. And if you start from the left-hand side, first of all, when you start to do financial modeling, as some of you I'm sure knows, if you model options and so on, you need to have different scenarios. You need to have some mathematics to substantiate, what is the potential outcomes of the risk you're looking at. So we need to have scenarios, climate scenarios, and we don't just need to have one. You cannot price something with one scenario. You need to have multiple scenarios. You need to have probabilities on those scenarios. So that is quite complex, and just in itself a very complex place to start. Once you have that, you need to apply that to macroeconomics. You need to apply it to different sectors. You need to apply it, if we move to the third step here, to individual companies, and you need to apply it to single securities and the assets, basically the balance sheet of the corporates. That is extremely complicated. And we are nowhere near where this can be done for all assets and all securities today. As an example, what we have been doing in BlackRock is that we've taken the example of commercial mortgage-backed securities, which is a very kind of a simple security actually from a climate perspective. Because what we can do is that we can model the physical climate risk of property by geolocation. So we can model risk of flooding on single properties. We can also model risk of excessive heating, whether an area becomes difficult to live in, or whether you would have agriculture there or not, and so on. So we can start to model whether the value of a property will be challenged in the future. And when you start to have that on the single kind of asset level, you can start to aggregate that on a pool of mortgages, and then you can actually start to calculate the impact of the price of that single security. So that's just one example, but imagine doing that on equities, different types of bonds in the capital structure, on different types of sectors, different places in the world. Imagine the amount of data that we need and the standardizations that we need. And imagine now that you apply this to a portfolio where the correlations between the single securities are not the same as it was in the past, because climate will also affect correlations. Then I think you can imagine that this is pretty challenging. And this is actually the reality of investors today. We have to face this. We have to make the choices of construct portfolios. So I'm very encouraged by the discussions of getting data, getting standardized, green bonds, different categories of securities, different types of ratings. But this is really an ongoing and iterative process. It is about both regulation, generating data, but it's also about the modeling and our ability to create a more precise picture of the risks in our portfolio going forward. If we look at just, in order to answer the question of how fast can we get there, if we look back in terms of financial modeling, Black-Scholes was in the start of the 70s, and financial modeling have taken steps going forward as we have computational power that has improved over time. But going into rates, credit default swaps, going into different types of baskets, going into value at risk, expected shortfalls, that has taken quite many years. Of course, now we are experienced and we have a lot of power to compute. But it will take years for us to develop this into a sophisticated framework and into a sophisticated level that we would like to see and where we are in modeling financial risk today. So just to sum it up, I think we can agree on the why, and the big challenge here is on the how. And one thing is that we issue securities and we have ratings, but modeling portfolio risk is super complicated, but it's something that we have to be very diligent on, and something where we need to apply a lot of resources as investors going forward. And hopefully also many of you in your jobs can assist us in terms of getting better data and get better at doing that financial modeling in the future. So thank you very much.